Good afternoon, everyone. I'm Seng, ETF product specialist from Lion-OCBC, and we are the asset management arm of OCBC Group and have been specialists in managing Asian equities and fixed income for the past 30 years. We are one of the largest asset managers within Southeast Asia, headquartered here within Singapore, with a regional office in Brunei. We have around 150 staff today, including 40 investment professionals, managing up to 60 billion of Sing dollars of assets for our clients. I'm here today to share about the Lion-OCBC Securities China Leaders ETF on how you can tap into the exciting growth story offered by China, the second largest economy and the second largest stock market of the world. Traditional blue chip companies have formed the foundation of China's growth, and now it has been and will be turbocharged by new innovation, where companies are rapidly adopting technology to future-proof their business models. Many of these companies are not just leaders within China, but global leaders as well. And through these ETF, you capture the growth potential of these Chinese leaders that foster innovation and transform the world. Today, China is the world's second largest economy, and all signs are pointing to the rise of China as the next superpower in the world. In short, China is too big to ignore. And if you look at the left chart, as of 2020, China's economy today is roughly at 14.7 trillion, and it is currently trailing behind the US, which is the world's largest economy at 20.9 trillion. And China's growth has also been resilient, achieving positive growth even during economic crises, such as the global financial crisis and also the COVID pandemic last year. And if we zoom into the history of China's economic growth, for a country that started with 300 billion GDP in 1985 to a giant with 14.7 trillion GDP last year, this is growth compounded 11.8% year on year for 35 years. And since the early 2000s, this gap between China and the US has been narrowing significantly. And based on just growth estimates alone, Chinese economy is expected to overtake the US in 2028. And in this scenario where the yuan appreciates further by 8% based on just today's exchange rate, China could even surpass the US in 2026, which is 2 years earlier than expected. And all these mean we are 5 years away from this happening. As of 2020, China also already accounts for 17% of global GDP. And the World Bank described the pace of growth experienced by China as the fastest sustained expansion by a major economy in history. The Chinese economy has proved to be resilient even in the face of the COVID pandemic last year. While the rest of the world was suffering from economic lockdowns and negative growth, China grew by 2.3%, weathering the crisis well by bringing the pandemic under control and keeping the economy running. And not surprisingly, China is expected to lead the world with the highest GDP growth potential in the next few years. According to the IMF, the forecast is for China to grow 8.4% this year and 5.6% next year. And this is way above US and the rest of the world. Other than being the world's second largest economy, China is also the world's second largest stock market. And as of end of last year, China's stock market already has a market cap of 12 trillion, which is split between 7 trillion within Shanghai Stock Exchange and 5 trillion within Shenzhen Stock Exchange. And the US and Japan have long been considered standalone asset classes because of their size and breadth and depth of their investment opportunities within their markets. Being the world's second largest economy and the world's second largest stock market, China should also be a standalone asset class in investors' portfolio, just like US and Japan. And backed by a growing and resilient economy, there are various catalysts that will drive long-term equities performance for China. I'll highlight the 4 key catalysts. First, domestic consumption will be the cornerstone of China's economy. Today, we are witnessing a growing middle class with rising consumption power. Second, China's capital market reforms have significantly increased the openness and attractiveness of its capital markets to foreign and institutional investors. And third, in terms of demographic trends, we are witnessing China's shift towards an aging population and towards greater growth within service industries. In terms of technology and digitalization, we are witnessing the rise of digital China, with it being a key agenda in its 12 and 13 5-year plans. As of 2020, China already has a middle class of 344 million, And to put things into perspective, this is double the size of the US middle class and larger than the entire US population. And within the next 5 years at around 2026, the Chinese middle class is also expected to exceed 500 million, which is 1.6 times of the entire US population. And this is also around the time where China's GDP will surpass the US GDP. And given this, a growing middle class with rising consumption power will be the anchor of China's economy. And by 2030, China's private consumption is also expected to reach 12.7 trillion, with compounded annual growth of 7.9% from 2019 to 2030. And this will make China a global consumption powerhouse. And by having the same consumption as the US market in 2030, China will be a self-reliant and self-sufficient economy capable of powering its own growth independently, even without global trade. So in short, the next 5 years will be a critical period of China's growth, and it is crucial for us to ride on this wave where China grows to become the world's next superpower. In terms of demographic trends, China's consumption is also shifting towards being more service-oriented. As you can see here, it will roughly take up 52% of industry makeup by 2030 at a size of roughly 5.2 trillion US dollars. And together with an aging population, this will accelerate and drive growth in service industries. By 2030, disposable income of age groups between 35 to 64 would also have doubled from 5.5 trillion in 2019 to 11.4 trillion in 2030. And the service industry is expected to benefit from this will especially be financial services, healthcare, insurance, and education. And armed with this strong foundation today, this positions China's industry leaders very well to evolve, to grow, and to serve the needs of tomorrow. As shown on the left, if you can see here, China's digital economy has grown 4 times from 9.5 trillion in 2011 to 39 trillion within 2020. And this is actually 17% year-on-year growth, compounded for 9 years. And accordingly, the digital economy's contribution to China's GDP almost doubled from 20% within 2011 to 38% in 2020. And accordingly, the participants and involvement in China's ecosystem also grew tremendously during this period. As you can see here, internet users almost doubled. Online shoppers almost quadrupled. Online payments users almost rose 5 times. And all these represent the effectiveness of China's policies to embrace digitalization from its 12 and 13 5-year plans, which saw accelerating digital industrialization and vigorous growth of new business models such as online education and telemedicine. And they have helped China evolve into a digital economy leader today. And looking to the next 5 years, especially on China's 14th 5-year plan, which covers this year all the way to 2025, it prioritizes accelerating of digital development and the building of digital China, from creating new advantages in the digital economy to accelerating digital development. And all these will further accelerate industrialization and digitalization, and deep integration of digital technologies, especially the industrial internet, big data, 6G, and AI into traditional industries such as manufacturing. China has also been active in reforming and opening up its capital markets. In 2002 and 2011, it launched the QFII and RQFII schemes to allow foreign investors to invest in China. And in 2014, China also launched the Hong Kong-Shanghai Stock Connect. 2016 particularly was an important year because the renminbi was included in the IMF's special drawing rights currency basket. And this further integrated China's economy into the global monetary system. The same year of 2016 also saw the launch of the Hong Kong-Shenzhen Stock Connect. And since then, overseas investors could trade A-shares listed on Shanghai Stock Exchange and the Shenzhen Stock Exchange. And in 2020, China further liberated capital markets by removing foreign ownership limits. And all these significantly increased the attractiveness and openness of China's capital markets in attracting capital, attracting growth, and making it a global powerhouse. As China has also been a traditionally closed market, China A-shares hasn't really been included in many indices. In fact, before 2019, there was no China A-share in the MSCI Emerging Markets Index. Nonetheless, things changed in 2019 when MSCI announced to include China A shares into its EM index. And as a result, if you see on the middle chart here, in 2020, China A shares made up 5.1% of the EM index. And since then, MSCI has announced they will include more China A shares to make up roughly 20% of the emerging markets index. And this will be crucial here in increasing acceptance of Chinese onshore equities, since the index inclusion now requires global and regional institutions to buy China A shares in order to track the index. And as of 31st March this year, 1.3 trillion already tracks the EM index. And when China A shares eventually take up 20% of the index, roughly 260 billion, which is 20% of the 1.3 trillion, is expected to be reallocated to China A shares. And we expect this to result in significant capital inflows into China A shares. And one way to look at foreign participation is through the Stock Connect investment flows. The Stock Connect schemes allow Hong Kong and foreign investors to buy special and selected companies listed on the mainland China and also listed within Hong Kong, which are both considered northbound trading and southbound trading respectively. And since the launch of these Stock Connect schemes, there have been significant capital inflows for both A shares and H shares in the northbound and southbound trading. And from the chart, if you see here, the northbound investment flows representing the net purchases grew from 1.7 billion yuan in November 2014 to 1.5 trillion yuan in December 2020. Accordingly, for southbound investment flows, it also grew from 12.1 billion to 1.2 trillion yuan within this same period. And according to the Hong Kong Stock Exchange, the northbound and southbound trading volumes set record highs in the first quarter of this year, indicating strong investor interest and providing technical support for both A shares and H shares. And until 2015, China's stock market has been dominated mainly by smaller retail investors. And this can be clearly seen in the purple bar in the left chart, where market volatility was in fact around like 3 times of the US, as many of these investors were using leverage and trading on momentum. And since the launch of the Stock Connect schemes, foreign and institutional ownership of Chinese equities have also gradually been on the rise from 2015 to 2020. This shift in investment profile is seen as beneficial because it means greater stability for Chinese stock markets. And if you look on the right, there's been a huge increase in foreign holdings of Chinese equities from less than 0.4 trillion yuan in 2015 to 3.4 trillion yuan in 2020. In other words, foreign investors now hold 4.3% of the total market cap of Chinese equities, and we expect this number to be higher going forward. And greater institutional and foreign ownership will be crucial here in reducing market volatility and increasing market stability. Another key advantage of investing in China A shares is the diversification benefit because they have demonstrated low correlation with global markets. For instance, its correlation with world equities is at 0.49 compared to US equities, which has a 0.99 correlation with world equities, or even Japan equities, which has a 0.95 correlation with world equities. And as you now see, China A shares do not really move in close tandem with the world equities market. And as such, by making allocations to China A shares, you may be able to diversify away some risks. And as shown on the chart here, for the past 10 years, the Chinese renminbi has also been strengthening against the Seng dollar. The exchange rate has risen around 5.35 in 2011 to around 4.80 within 2021, appreciation of roughly 10%. And in fact, the Chinese foreign exchange trade system RMB index recently rose to above 98 for the first time in more than 5 years. And in the near term, there's an ongoing bias for the renminbi strength because the Chinese economy is expected to outperform other major Asian and other world economies. And the Chinese renminbi is also not held hostage by low or negative interest rates, unlike other developed economies. And all these present potential currency upside. And at this stage, we see China as an excellent beta opportunity. There's strong economic fundamentals, with its stock market backed by a 14.7 trillion economy that is set to grow further in the next decade. China also has solid companies containing numerous industry leaders with solid competitive advantages and business models to drive earnings growth and ROIC. And after its capital market reforms, China's stock market is also well positioned for long-term sustainable growth. For China's next decade, it is a decade we must not miss. Now, let me introduce you the Lion-OCBC Securities China Leaders ETF, where you can gain easy access to 80 China market giants. And after we observed a growing and strong interest in both ETFs and Chinese equities, we collaborated within the OCBC group to launch an ETF to serve these needs. And through the Lion-OCBC Securities China Leaders ETF, you can gain broad-based access to China. And we have built the ETF to focus on industry leaders and crafted a less volatile portfolio, well diversified across 12 sectors, and well positioned to capture the growth of China's next decade. The ETF will track the Hang Seng Stock Connect China 80 Index, which selects the 80 largest Chinese companies listed on Hong Kong Stock Exchange, Shenzhen Stock Exchange, and Shanghai Stock Exchange. And there is one important point I wish to highlight here. This will be the first China-focused ETF that will make a distribution in Singapore. As this ETF passively tracks an index, it is also crucial to have a well-constructed index with tradable and quality constituents. And we are happy here to partner with Hang Seng as the index provider. And based on this index methodology, the index has 80 companies and 106 stocks, because some companies are listed in both mainland China and Hong Kong. For example, Ping An Insurance and ICBC. And through these selection criteria, the methodology filtered an initial universe of 1,900 stocks, made up of 1,400 A shares and 500 Hong Kong listed equities, to the 80 constituents you see today, which is roughly 4.2% of the universe. The eligible stocks must also fulfill the geographical requirements, for example, 50% of revenue from mainland China, and also turnover requirements. Thereafter, the eligible stocks will be ranked by company market value, with the top 80 selected as constituents. And the weights of each constituent are then weighted by free float adjusted market value. The index will also be rebalanced quarterly to ensure you are exposed to industry leaders that drive China's growth and expansion. There's also an 8% securities weightage cap and 40% sector weightage cap to ensure a diversified portfolio of industry leaders. As we also intended for the portfolio to be diversified, it is a combination of old economy and new economy stocks that is set to benefit from the catalysts that drive Chinese equities performance. As shared earlier, an aging population and rising middle class will drive growth in service industries such as financial services, healthcare, insurance, and education, which are all captured in the ETF. If you refer to the right, 63% of the constituents are listed in China, with 24% in Shenzhen and 39% within Shanghai Stock Exchange, with the remaining 37% listed in Hong Kong. Since 2014, the index has also performed steadily. On a cumulative basis, it has outperformed other indices, for example, the Shanghai Shenzhen CSI 300 Index, the MSCI China Index, the MSCI World Index, and also the MSCI EM Index. Here, you also see the top 20 constituents, with many of them being household names that are consistently industry leaders. For example, Ping An Insurance, Kweichow Moutai, ICBC, which is the world's largest bank, and BYD. They are not just leaders within China, but also global leaders as well. And as of August 2020, there are more Fortune Global 500 companies from mainland China and Hong Kong, which add up to roughly 124, compared to the US, which only has 121 names. And 1/3 of the index constituents here are already included in the Fortune Global 500. Among these constituents, Kweichow Moutai was the favorite drink of Mao Zedong, who is China's founding father, and who also served it at state dinners when former US President Nixon visited China back in 1972. And since then, it has been the brand of choice for elites at business banquets and considered a status symbol because of its premium price and also its limited supply. Globally, Kweichow Moutai is the world's largest liquor company by market cap, bigger than Diageo and Constellation brands. It is also larger than Coca-Cola, which has long been the world's largest beverage maker. And being valued at 2.4 trillion yuan, or roughly 380 billion USD, Kweichow Moutai is larger than Toyota, larger than Nike and Disney, and also larger than ICBC, which is the world's largest bank. So imagine the scale of a liquor company for it to be larger than the world's biggest bank. Another constituent, CAT-L or Ningde Shidai, is the world's largest EV battery manufacturer, supplying batteries to powerhouses like Tesla. And as of this month, the net worth of its founder Zheng Yuqun officially overtook Jack Ma, with this being a symbolic moment in the clean energy and innovation boom. So to conclude, through these ETF, you immediately gain exposure to 80 China market giants, backed by a strong foundation to foster transformation and innovation. And with less than 25 Sing dollars, you will be able to participate in China's growth story. The SGX tickers here are very easy to remember. YYY for the Sing dollar counter and YYR for the renminbi counter, with issue price at Sing $2 and trading board lot size of 10. So I hope my sharing today offers you a perspective of how you can invest and participate in China's compelling growth story with less than $25. Thank you so much for listening in.